Hello, everyone, and welcome back to Sudden Wealth. I do hope you're having a wonderful end of the week. If you do enjoy the content, please consider dropping that like and subscribe. We are quickly approaching 600 subscribers, so thank you very much for your support. Now, apologies for today not posting a video. As I mentioned, I was on business trip. As you can see, I'm back at the castle. I did catch a bit of a stomach virus, so it's not going that well here on my side. But I am planning to do a live stream tomorrow, so I will probably schedule it today. So I hope to see many of you there so we can discuss some exciting things. Now, today I wanted to discuss two things, and I will only make a video today. I'm still kind of recovering, so I hope that you forgive me for that. Now, number one is the stock market. Stock market seems to be stabilizing, as I said, remaining above 4,200 on the S&P was very important. We seem to be stabilizing. We seem to be trying to put in a bottom. Indeed, I also expect crude prices to start to level off going into the first half of October, but this is a bit more unpredictable because OPEC can come tomorrow and say, oh, we're gonna cut even further production, and all of a sudden the whole thing goes out the window. I wanted to reference something which is a little comparison between me and Mr. Peter Schiff. So you may recall that around in June I did predict gold to go to 1850 I meant to say by the end of August, but I did say by the end of July. In any case, both of them were wrong. Now, for you to have an idea, this was at the time that gold has been many times above $2,000, and even though I was wrong on the timing, we actually ended up coming into the 1850. Why? Because there was a long-term trend on the SMA 50 that was telling me that by the time we arrived in the future, I miscalculated the month. So I'm sorry for that. But I was sure that we are not going to stay above 2000 for far too long, and that we're going to go to 1850 at least. Now contrast this with what Peter Schiff told you. When gold was above 2000, he was shouting at people to buy as much gold as possible because these would be the final days of gold above slightly above 2000. And then it's going to rampage up to 3,000, 2,500, 5,000, the whole shebang. And what I wanted to say is, look, this is a guy who who makes millions of dollars by selling gold, selling terribly performing funds, by having a podcast, you name it. And this is a guy who's constantly wrong. I mean, I've seen the comments on this channel and the amount of people pissed off because they went all in gold again based on what he said is the classic Peter Schiff effect, which is destruction of portfolios. If you give me 1 second, sorry about that. And I'm actually going to probably discuss this because I do think that gold is starting to lose its place as an inflation hedge. I mean, it seems that we don't really know what to do of it, and that merits a video actually, but that's beyond the point. Beyond the point is, like, people are always looking at the wrong things. It's like if the deficits are going higher, so the government will print more money, and the printing of money will actually create inflation, blah, blah, blah. No, the most important things for inflation is supply and demand. When you give money to people directly into their homes and you tell them, stop going to work, so you give them extra money and stop going to work at the same time, you're going to pay a price because there's too much supply of cash in that people's hands for the amount of goods that is actually decreasing. So that's a big barrel for inflation. But the lowering rates and printing money is not necessarily inflationary in the sense that people think. Yes, it inflates what? Real estate. It inflates what? It's the stock market. So instead of costing you $1,000 to buy the S&P, now it costs you $5,000, for example. That is the inflation that you actually see, because the reason is actually quite simple. If you're a person who's completely indebted, if you go to a bank and interest rates are 1%, they will not lend you money. because you are already super indebted. So it's not the point of, oh no, but I'm going to charge you 5% or 6% or 3% or 2%. Who cares? That person is such in a dire strait that he's going to see no money at all. At all. Get it? So the same way that when interest rates go up, this person is in the same. They cannot borrow any more money. What may slow down is spending from rich people. But because you have inflation in the market at the same time, in real goods, now we're talking about cars, groceries, insurance premiums, tickets, you name it. Now that everything is inflating, what do rich people have the incentive of doing? Buy assets. Assets that actually go up in price when this happens. Buy businesses. Buy buy crucial businesses that you can pass through the increased cost of raw materials to your consumers. Buy residential real estate, and then you increase the rents to people in line with inflation, etc., etc., etc. So people, rich people in this context, are actually still spending money. But for Peter Schiff, he thinks that if the Fed prints money, that's it, inflation. So the price is going to go up. No. What if they print $1 trillion and bury it in the ground in the same place? Now you have extra $1 trillion, but it's not actually going anywhere. I'm talking about real economy inflation. Because yes, when they print money, and you can see that, the correlation between the S&P 500 and the M2 money supply is 99%. It's very simple. The Fed increases the money supply, the S&P goes up in the same direction. I mean, it's almost a one-to-one, which makes a lot of sense. If you are a very wealthy person, I mean, there's limits to how much things you can buy. If you are a struggling person, which unfortunately many Americans in particular are, where you have like 65-70% that live paycheck to paycheck, in most cases they are already extremely indebted. So the interest rates can be negative, that no bank is going to say, I'm not going to lend any money to this person, only if I were crazy, unless they are forced to do it, or they are just given money, like during COVID. Then you get real inflation. And, of course, by stupid decisions by the administration, like shutting off the Keystone pipeline, like not drilling for more oil and gas, then the oil prices go up. The energy prices are the basis of any economy. Why? Oil prices affect gas prices, which affects heating, which affects electricity, which affects food, for the greenhouses, for transport, fertilizers, petrochemicals, transport, shipping, some parts of healthcare. So the point is, the energy is the basis of all economies. And if you have attitudes that push the oil prices up and the gas prices up, guess what? You will pay a higher price. And particularly if you have a conflict between the third largest oil and gas producer in the world and the fifth largest food producer or fertilizer producer in the world, then that's another rampage of inflation on top. So, but what I'm trying to say here is that there are certain reasons why we are still moving higher on the stock market. There is still reasons why a lot of things are not collapsing, global depression 2.0 kind of things. It will come up a time where that may happen, but you need a lot of things in between, which I will be covering over the years with you, because I've already told you, I do think we're going to see new all-time highs, but I said that most likely this decade will not be very good for the stock market. Now, there's a big caveat, there's a big uncertainty here, because I am not qualified enough to assess the entire impact, which is artificial intelligence. Because artificial intelligence can explode our productivity in such a way that may cancel out even the mistakes we did in the past. So I want you just to remember this number here, because this is very important. The biggest technological development in the history of mankind in one single year was we jumped 50 years in one single year. That was the greatest year of all time. Artificial intelligence is now projected to add to put us 1,000 years into the future in 10 years. That's an average of 100 years per year, which is double the human record. So think about what does that mean? That is something that I'll need to analyze through time. If somebody is telling you exactly how the future is going to look like, step by step, year by year, they are conning you, and they make money out of you listening to them, of you buying their products, and of you getting completely wrecked. So those were the thoughts for today, guys. And key items is it's important to remain above 4,200 in the S&P. Today's stock market is a bit, I would say, around flat. I mean, some indices are a bit down, some indices are a bit up. Crypto seems to remain resilient, and gold has pretty much just went straight down. And the reason for it is we actually had to go test a few moving averages from some long-term trend lines, but of course that Peter Schiff just wants you to buy gold. And of course, I can already guess his podcast. This is a wonderful buying opportunity. Just like when gold went from 1900 to 1050, from 2011 to 2015, he was telling people that all along the way, it was a wonderful buying opportunity. And not to buy Bitcoin because it had topped at $100. So this is your little friend. So be very careful with these finance experts. And of course, the bond market has completely collapsed, which had two other experts loving it, which was Harry Dent and Steven Van Meter. These people don't make any money in the market. They make money out of you listening to them, looking at their interviews, buying their funds, buying their books, or in the case of Steven, promoting garbage stocks in exchange for money. So thank you very much, guys, and I'll catch you in the next one.